You have $1,000 to invest. You find Metro Coffee, 3,000 locations worldwide, a recognizable brand, a 10% dividend. That's $100 a year, cash in your bank account while you sleep. So you buy it. It's only $15 a share. You tell your wife. You feel smart. 1 year later, the dividend gets cut in half. The stock drops 40%. Yes, you collected $100 in dividends, but you just lost $400 in capital. You are down $300 net. And you are sitting at your kitchen table wondering, how did I not see this coming? The answer was sitting in 3 documents. 3 documents that every public company is legally required to show you. And they were screaming at you the entire time. Most investors never read them. Today, that changes. Hi, I am Nick, the guy with a Greek accent, a long-time value investor with an obsession for getting this right. And in this video, I am going to show you what financial statements are, why they exist, and what each one is actually telling you as an investor. By the end of this series, you'll know how to read financial statements and decide if a stock is worth your money. So, what are financial statements? Every public company, every company whose shares you can buy on a stock exchange, is required to publish 3 financial documents at the end of every quarter and every year. These are not marketing materials. They are formal records, verified by independent experts that tell you the financial truth about a business. Warren Buffett calls accounting the language of business. He reads these documents before he reads anything else, before the news, before the headlines. He put it plainly, unless you are willing to learn how to read financial statements, you really shouldn't select stocks yourself. Most investors use financial statements to find bargains. That's not what we're doing here. The primary job of a value investor is not to lose money. These 3 documents are your filter. You are looking for reasons to say no. Most stocks you look at, you should say no to. Financial statements are how you find out why. And that discipline to say no to 99 things out of 100 isn't caution, it's preparation. Because when the right business finally appears, it shines. So how do you tell the difference? Each document asks one question that cuts through the noise. What does the business own and what does it owe? Is it profitable? And is it actually generating cash? 3 questions, 3 lenses. The balance sheet is a photograph. The income statement is a film. The cash flow statement is your bank statement. Together, they tell you the full story. Separately, each one can fool you. In the videos ahead, we will go deep on each one. What we are getting right now is the bird's eye view, the map before we walk the territory. Let me show you each one. Document 1, the balance sheet. The balance sheet answers the first question. What does this business own and what does it owe? Not over a year, not over a quarter, at a single point in time. Think of it as a photograph taken on a specific day. On one side, everything Metro Coffee owns. Cash in the bank, coffee inventory, the equipment in every location, the espresso machines, the refrigeration units, the furniture. The 3,000 locations themselves. These are called assets. On the other side, everything Metro Coffee owes. The loans they took out to expand. The money owed to suppliers. The debt that needs to be repaid. These are called liabilities. And the difference between the two, what is left for the owners after every debt is paid, is called equity. The true net worth of the business. Here is the rule that never breaks. Assets always equal liabilities plus equity. Always, without exception. Metro Coffee owns $500 million in assets. It owes $350 million in liabilities. That leaves $150 million in equity. Both sides always balance. This is why it is called a balance sheet. Now here is what most investors miss. That $150 million in equity sounds healthy. But buried inside that $350 million in liabilities is a number that has been growing quietly for 4 consecutive years. We are going to find that number in the next video, and when you see it, you'll understand exactly why the balance sheet never tells the full story on its own. For that, you'll need the second document, the income statement. Where the balance sheet froze time on a single day, the income statement covers a full period, a quarter or an entire year. It shows you whether the business made money or lost it. It starts at the top with one number, revenue. Every cup of coffee sold across every Metro Coffee location, every pastry, every bag of beans, the total money that came in. This is the top line. Then it subtracts expenses, layer by layer, the cost of the coffee beans and ingredients, the staff wages across 3,000 locations, the rent, the marketing, everything it costs to keep the business running. What is left at the very bottom, after every expense, is called net income, profit, the bottom line. For Metro Coffee, that bottom line is $100 million. That sounds impressive. That sounds like exactly the kind of business you want to own. But here is what most investors never question. Profit is not cash. A business can show $100 million in profit and still have no money in the bank. How? Because the income statement uses something called accrual accounting. Under accrual accounting, revenue is recorded when it is earned, not when the cash actually arrives. December, Metro Coffee delivers $200,000 of coffee. The cash won't arrive until February. The income statement calls it profit today. Your dividend is calculated on money that isn't there yet. The same principle applies to expenses. An espresso machine dies. Metro Coffee writes a $10,000 check. That money is gone, but the income statement only shows $1,000 this year, spreading the rest over a decade. Multiply that across 3,000 locations. The gap between what left the bank and what the income statement shows is enormous. This is not fraud. This is not manipulation. This is the standard accounting method used by every public company in the world. But it means one thing for you as an investor. The income statement can look healthy when the underlying reality is not. To find out what is actually happening inside Metro Coffee, you need the third document, the cash flow statement. The cash flow statement asks one simple question. How does the cash actually flow? Not when the sale was made, not how the cost is being spread, not what the accountant decided to record, just real money physically moving in and out of the business. Metro Coffee sold coffee to a corporate client in December. The client pays in February. The income statement counted that money in December. The cash flow statement waits until February, because that is when the cash actually arrived. Same with the espresso machine. Metro Coffee signed a $10,000 check in March. The income statement spread that cost over 10 years, $1,000 per year. The cash flow statement recorded the full $10,000 in March, because that is when the money actually left the account. No adjustments, no spreading, no timing games, just cash. The cash flow statement has three sections. Cash from operations, the money the business made or spent just by doing what it does. Selling coffee, paying staff, keeping the lights on. Cash from investing, the money spent or received buying and selling assets, new locations, equipment, or entire businesses. And cash from financing, the money coming in from lenders and investors and going out to repay them. The income statement reported $100 million in profit. Cash from operations, $180 million. Strong. If we subtract what Metro Coffee had to spend on its locations, maintaining existing sites and expanding, $150 million. That money left the bank regardless of what the income statement said. What is left is $30 million. That gap, $100 million on paper and $30 million in reality, is what investors call free cash flow and what I call the paper profit trap. The income statement said one thing. The cash flow statement said something completely different. Right now, all three financial statements are telling you something different about Metro Coffee. What does it own and what does it owe? $500 million in assets, $350 million in liabilities, $100 million in equity, healthy. Is it profitable? $100 million in net income. Very healthy. Is it actually generating cash? $30 million. Not $100 million. 30. 3 questions, 3 very different answers. And a $70 million gap hiding in plain sight. Most investors see the $150 million in equity and stop. They feel reassured. They move on. But inside that $350 million in liabilities, buried in a single line most investors scroll past, Metro Coffee's long-term debt has been growing every year for 4 consecutive years, while the dividend looked safe, while the stock sat at $15 and you felt smart. That line is exactly what we are looking for, a reason to say no. In the next video, we take a deep dive into the balance sheet. We find that line, we understand what it means, and we learn how to spot it before it costs you 30% of your money. I'll see you there.